Emotions, the hidden ingredient. The equation of demand and supply, the battle between bears and bulls, is what creates the market. When the bulls are in control, demand and consequently price increases. When bears are in control, supply increases while price decreases. Even though the market equations are made of two elements of supply and demand, there is an additional ingredient that has an even greater influence: investors' perception and emotions. It almost does not matter how well a company is performing. No debt, balance sheet, strong past earnings. What matters the most is the investor's perception of how strong or weak the market is, how well a company does or does not. If a company is perceived to be doing well, investors want to own shares of the company, so they buy shares and the price goes up. If a company has good fundamentals, but investors perceive that they can make higher profits somewhere else, they will sell the company shares, causing the price to drop. Below is the monthly chart of Apple. The Nasdaq symbol is AAPL, from 2010 to 2013. Each bar represents 1 month. Apple is an excellent company, and yet, in the period between October 2012 and May 2013, about 8 months, the price of their shares dropped almost 50%, from $100 to just about $50. If you own Apple shares during that period of time, what would you have done? Perhaps you would be thinking, Apple is a great company. I'm going to hold on to my Apple shares, thinking the price is going to go back up again. 1 month passes, 15% down. 2 months passes, 30% down. 4 months passes. The shares have now lost 40% of their value. What are you going to do? Are you buying more shares to compensate your losses? What if the price keeps going down for another 4 months? By the way, it does. Is the pain of losing more money so great that you can't take it anymore? Are you going to sell all your Apple stocks? This is exactly what emotions do when dealing with market trends and market reversals. A price that goes up must come down. A price that goes down must come up. Knowing when to get in and out of trades is the job of the trader. Candlesticks show us just that. Supply and demand are the obvious elements of the market equation. Emotions are the hidden one. Finding the hidden element is the key to successful trading. Investor sentiment of emotions and decision making. The same equation is also true with regard to the general market direction. If job reports are strong, sales are increasing, earnings season is promising positive returns, the overall investor's perception of the state of the market is optimistic. As a result, they will buy and invest, driving the prices up. On the other hand, if their perception is more pessimistic because of poor job reports and other weak economic signs, investors would be more inclined to sell, driving the prices down. The investor's perception and their optimistic or pessimistic view of the market conditions, stock or any other trading security, is referred to investor sentiment of emotions and decision making. Investor sentiment, and more specifically the emotion of fear and greed, are the most important elements of the market equation. Supply and demand are two elements of the market equation that can be analyzed using many indicators available today. Levels of support and resistance, time and sell, level 2, total view, MACD, RSI, and many more. What indicators or piece of technology are we going to use to determine the dominating investor sentiment of emotions and decision making? The answer is candlestick patterns. The doji, the bullish harami, bullish engulfing, bullish kicker, bearish harami, bearish engulfing, bearish kicker are just a few examples of powerful Japanese candlestick patterns. Homa, the father of Japanese candlesticks, discovered the importance of emotions and their influence in investors' decision-making. He knew that the movement of price action was not only the reflection of supply and demand, but especially the price was greatly influenced by the emotions of fear and greed that every trader experiences. Homa understood that when emotions are part of the trading equation, the difference between the price that people are willing to pay and the true value of what has been sold could be quite significant. He studied the market, identified the effects that emotions had on price actions, and developed candlestick analysis. The charts below are the same monthly Apple charts that we discussed the previous lecture. The chart on the left is a bar chart, the chart on the right is a candlestick chart. If you knew candlesticks, you would have noticed the appearance in October of the shooting star, a candlestick bearish reversal pattern indicating that the market or stock trend is about to change direction. In November, a big red candle appeared indicating that the market sentiment in regard to Apple has turned pessimistic or bearish. As the first red candle was forming, please remember that it took 1 month to make that kind of candle. You would have had plenty of time to get out of Apple and hopefully have made a decent profit or at least preserve your capital. In July, after several months of a downtrend, you would have also noticed the appearance of a green candle, forming a candlestick pattern very similar to the bullish harami signal. The bullish harami is a candlestick bullish reversal pattern indicating that the market or stock trend is about to change direction. In August, another green candle appeared indicating that the market sentiment in regard to Apple has turned optimistic or bullish. Japanese candlesticks show exactly when investor sentiment of emotions and decision-making have changed, and give us a very clear and distinct signal of when to get into a trade and when to get out of a trade. Very simple and very effective.